Good morning, everyone. Give it a couple of seconds to allow everyone to come into the room. To those of you who are with us now, my name is Lauren Simpson, and I'm with the Sbdc, or the Small Business Development Center. And I am joined today by my fabulous colleague, Lori Williams. Good morning, Lori.
Good morning, Lauren. Glad to be back.
I know, for another amazing Wednesday. We're at the middle of the week, and I know you have tons of information for everyone.
I sure do. Tons of information, and it's open forum on questions. I already received some questions I'll be addressing. We got them through our link, which Lauren's going to tell you all about that in a minute. And then anybody who has questions can write them in as well.
That's right. Good morning to you, Dave. I see your shout out. Thank you for joining us again.
Yes, and I was also going to mention, I think now anybody who requested a one-on-one meeting, I have gotten in touch with them. So if you sent in a request, you didn't hear back from us, please send it again. We didn't get it. I think we're all caught up on questions and individual appointments.
That's correct. That is correct. Good morning, Tova. I see you there. Good morning. Good morning.
Our frequent flyers.
Oh, yeah.
Our frequent flyers. Thank you so much.
So, Laura, we have more coming into the room, but I'm going to go ahead and get started. Good morning again. My name is Lauren Simpson, and I'm with the Sbdc, or the Small Business Development Center. And I'm going to share a little bit of background as to who the Sbdc is and what we do. And so we are a national program with over 1,000 locations throughout the country. I say this every Wednesday, but no matter where you are in the country, no matter what city, you should be able to get connected with a local Sbdc office. And we offer no-cost services to local small businesses. Again, the operative word is no cost, no cost. And that's no cost because your tax dollars are at work. And so since your tax dollars have already paid for it, you might as well take advantage of the resources that we offer. And then for the Los Angeles network, which is the network that I represent, there are several locations that you can be connected to, as far out as Camarillo, Santa Clarita, over to Pasadena, down to Long Beach. And so everywhere in between, you should be able to get connected with a business advisor, an expert within the Los Angeles network. Deeper dive into what it is that we do. We offer no-cost business advising. And so like Lori mentioned, those of you who have reached out to be connected with a business advisor, those are experts in various fields, from marketing to finance, tax experts, business planning experts. And so those are the types of advisors that we have available to you. And then we also offer virtual trainings, much like what you've joined today. And then finally, to get in contact with us for the LA area, 866-588-7232. or online, smallbizla.org/new client. And then for those of you who are outside of the Los Angeles network, welcome. But you can get connected with a local office via americassbdc.org/find your SBDC. And so I'm going to stop my screen share really quickly, Lori, some last minute housekeeping rules. If you're new with us, those of you who have questions, please be sure you enter those into our Q&A. Again, all questions into the Q&A, because we want to be sure that Lori is able to get them addressed to the best of her ability today, if not in the next few days. And then for the chat, monitor that, because you'll find resources like links and things that Lori mentions that I will include there. With that, keep an eye out for a link I'm going to post very soon. It'll be a link to a form that we offer, Lori. And it's that form where people can suggest show topics as well as submit questions. And then also a link to our YouTube where you can catch our latest shows. So with that, good morning to you, Mary. Thank you for the shout out. Again, for our frequent flyers, welcome back. And I'll pitch it over to you, Lori.
Oh, wonderful, Lauren. I got to say, Lauren is terrific in managing the chat. I know a lot goes on. I'm oblivious to the chat during the whole time, but I read it later and I'm just amazed that everything happens. Keep in mind, if you have questions, you need to put them in the Q&A because that's the only one I see during the show. I'll sometimes glance at the chat if I can, but you can imagine I got a lot of windows up. So today we're going to have a bunch of questions answered, and I'm really going to be kind of managing a ton of different screens here. So you guys will have to give me a little bit of leeway as I start moving from one screen to another. Before we start, I want to tell you that we got great lineups for the next couple of months. I'm starting to get shows booked way in advance, and I'm bringing on different topics that I know some of you will be able to relate to. So the next week, we're going to talk about selling products online. It happens to be a body care product, but the guest is going to go into all of the information and the challenges, just like everybody talks about running their company. And then we'll be talking about owning an Airbnb business. Then we'll be talking about designing and sourcing clothing apparel. And then 1 month from now, I'll have another Learn from Lori session. Lauren's going to start collecting everybody's bio, everybody's information. We'll be posting that. So I'll be telling you who all the guest speakers are. But at least today, I wanted to get all the information on that what we have coming up. So what I'm going to do is I'm going to start with, I'm going to be kind of like I say, mix and match because I'm answering different questions here. So the first one that I'm going to start with is, let me get a presentation up here. Let me find which one I'm going to share next, is going to be this one. Okay, so the question that I'm going to answer, and this is someone who emailed through that link the question to us. So let me grab the question too. So someone wrote in, and what they had done is they filed for an LLC the summer of 2021, and a new business made $1,300 in 2021. And the question is, am I to pay the $800 you pay annually for having an LLC? So there's a couple answers to this. The first one is, for the very first year, you are not responsible for paying the $800. That was one of the special situations that was created for the pandemic. But the following year, which would be 2022, you are responsible for paying the $800. But with that said, I want to make a very clear point. It does not matter how much you make in the company or how much you sell that defines whether or not you have to pay the $800. So let's take this pandemic situation and let's set this aside. If the company doesn't do anything all year long, the company must pay this $800. So that's where I see people get themselves into trouble, because what they do is they start an LLC, good intentions, plan on doing something, they don't do it, and then they keep it open. As long as it is legally open, in other words, not legally dissolved, you have to go through a process to dissolve it. You have to pay the $800. And by the way, this is an S Corp too. It just happened to be a conversation about an LLC. So these are corporations as well as LLCs. So with that, what they do is they end up not paying, and you are going to be fined and owe the tax, and you can't disclose or dissolve the corporation until you paid it. So you get in kind of a circle. You've got to catch up with the back payments before you can dissolve it, and you can't dissolve it until you catch up with the back payments. You see where you're going with this, right? So yes, you do have to pay this. Now, the other half of the question was, what can I do? Do you have some kind of template or something that I can do to get accounting in order to share when filing taxes? Do you have a checklist of the items that you should prepare when meeting with your tax person for the first time? And I'm going to answer those now. Now, what I have is a lot of times people come to me and they haven't put together any of their documents, whether it is for taxes or, I want to say, just basically for your own internal accounting. So what they end up doing is at the end of the year, they have to go through the bank statements, they have to categorize everything. If you go through your bank statements, you still got to identify that this money was for marketing, this money was for rent, because these are different categories on a tax return. But even if we just don't even consider the tax form part of it, the component of a tax form, you really need to have this information together for you. So these slides I'm going to show right now is just introducing you to a very simple concept using an Excel doc. Most people, they think either they do nothing or they're all the way into a QuickBooks. And I know you guys have heard me say this before. I often recommend Excel documents for your accounting if you have very few transactions, and not even to get into QuickBooks right away, because QuickBooks is confusing and it's often not done correctly. And in Excel, at least, is what I call transparent. You can look at the different tabs and you can see. So this is just a quick run through on what I'm saying. Let me get it to come over here. What I'm suggesting that you can do in the simplest format. So that's all this is let me introduce you to the simplest format. So I don't care whether you use a shoebox, you use a file folder, Excel, QuickBooks, you can do it in any way, but here's a very simple way to organize. Now, I always like to tell people when I talk about an accounting system, this is one of those Loriisms. I say it has to be three things. It has to be accurate, efficient, and consistent. And the reason I say all three is obviously you want to be accurate, right? But if it's not an efficient system, if you go, oh my God, I got to sit down, I got to think it through, I got to figure it out. If it's not something you can just pick up and do, you won't do it often. And then you'll go back to do it later at one time and play catch up, and then you're not consistent. So I'm into the simplest format for you that satisfies the accounting requirements given the size, transactions, and type of transactions, and it's easy for you to do on an ongoing basis. And for many, it can be a simple Excel worksheet. So all I'm saying is you create one tab up here. I'm saying is a tab, and you can do something like date, payment type. You can do invoice. You can do sales tax. Now, if you're using a POS system, just go ahead and put the POS date in. Say, Shopify on this date. And I know I've gone through this before, but I just want to go through one more time because this really is the answer to the question and to answer to many people's situation. Then you can have a cost of goods. And you can just have date, vendor, description, anytime you've made payments on the credit card, whatever. What you're able to do then, since you're putting on this tab, if you total the sales, you can total the cost of goods. You not only have internal information, but you have information for your tax. Overhead, same thing, just simple Excel document like this. You can call the categories anything you want. I'm just giving you examples. Like if you're just doing it for taxes, you wouldn't need method of payment, right? You would have something like, maybe the vendor you might not even need. You could just have the date and it could just say the month, because if you're doing it for taxes, it could be month or year. You want to do this on a monthly basis so you have an idea when these occurred. So you could have the date, the month of March, for example, description of expense, rent, and the amount. Now you've got a category of how much rent you spent each month, and you can total these for your taxes. If you're using QuickBooks, I know I brought this up before, but please, before you submit any of your information for taxes, run a balance sheet and make sure there's no negative numbers in these areas of assets and liabilities. If there are, you've got to research it and ask why, because it usually is an issue with the transactions, which is an issue with syncing. I can't tell you, I look at, so many QuickBooks online, and I think yesterday I finally saw one that was done properly, and it had been done by an employee that had an accounting background, which makes sense to me. So a lot of times it's just not done properly because, as my mother used to have this famous word, amok. They just let it run amok, so you sync up your bank account, you sync up your credit cards, and you just push a button, you think it's magically going to work, and unfortunately it doesn't. So what I'm trying to get you to do in these Excel document, this example, is if you think about it, and let me enlarge this a bit so you can see it. So I had a tab for sales right here, gross receipt sales. I had a tab for cost of goods right here, cost of goods. I had a tab for expenses, which you could use these headings for your tax returns. Obviously, you won't have all these headings on your tax return, but these are example of headings that you would use. This is a Schedule C that is for a sole prop as well as an LLC. And here is a 1120S for an S Corp, which has the same thing. They're just in a different order. So my purpose of what I just shared with you is that if you're trying to prepare for taxes, you have not organized your data, or you just need something simple to do your accounting here on, an Excel document can be a perfect choice. I do a lot of customization with Excel documents, help people do the categories and everything through the Sbdc. So if you need any more assistance on that, reach out. Now, I want to make a mention. There was someone who emailed a question about a trust, and you might probably are on the line today. And I just wanted to let you know that is way too involved. It's more of a personal trust situation. I'm more corporate, so I could not answer that. You would really need to get a trust lawyer to answer that, because you don't want to take any chances of doing anything incorrectly within the trust. So you really need to get the person who set up the trust to help you with that situation, because it's a very delicate situation. So that's just a shout out to the person who sent that, so they know that I answered it. Okay, so guys, now what I'm going to do is I'm going to get back to these questions, but I want to quickly go over now the sales tax. I was going to bring that up. So let me get this next document launched. Lauren is going to be putting into the chat everything on this document. It won't make sense until I go over it completely, but I'm going to share it with you on my screen, and she's going to be putting it in the chat for you to grab right away. So let me go back to this. Okay, so what I'm doing here, guys, is our guest last week was talking about sales tax. And I see so many people making horrific mistakes on sales tax. I want you to at least have a comprehension of how sales tax is done. I'm not saying that you're necessarily going to do it on your own. You may be hiring somebody. That's fine, as long as you find somebody that knows what they're doing. But I am a firm believer that if you hire out to have anybody do anything financial in your business, know enough about it so you can make sure it's being done right. I see so many times, especially when I did a lot of my turnaround consulting, I would see people have, well, my CPA handles all this, or my accountant handles all this. They had no idea what they were doing, and usually there was holes or something. And at the end of the day, guys, you are kept accountable, okay? So I want you to understand the sales tax. So first of all, when you go on any type of website service that you're using, that you're using a shopping cart on, make sure you fully understand what that site is providing. I mentioned this a bit last week. Shopify is a very good example. I'm not saying anything against Shopify. I'm just clarifying how they handle sales tax. So they have a little box. And I'm not a Shopify expert. I just know enough because I've worked with people on Shopify from the financial end. But they have this little box that you check that says sales tax, and I've had people check that box. And what that box does is adds sales tax to the invoices. That's all it's doing, is adding sales tax to the invoice, right? It is not resubmitting the sales tax to the government officials. You still have to get your own selling permit. You still have to take that money that's put into your bank account and submit that to the appropriate government agencies, right? So I've seen this way too many times. People click that box believing that it is collecting the sales tax and resubmitting it like Amazon does. It's not. So they didn't get a selling permit. They are now collecting sales tax. It's being deposited into their bank account, and they're keeping it without realizing. So I hate to say, but if you look at that, it's fraud, because you're collecting sales tax without a selling permit and you're keeping it in your bank account. That could be some pretty scary stuff. Now, when I first saw it, I was like, okay, that's one person. I've now seen it with multiple people making this mistake. So that's why I really, really want to make sure I clarify this. Now, like I said, if you're using any kind of website, you just want to make sure that they are remitting it. So just because they're collecting it doesn't mean they're remitting it. So that's the key aspect that you want to understand. Now, there's another aspect that changed about sales tax some time ago. This document is like an instruction sheet that I wrote up for everybody. And so, like I said, it's going into chat. I'm just going to give you a background on it. And it's just me kind of giving an example to help you understand. What it refers to is economic nexus. So prior to maybe 3-4 years ago, sales tax was based on nexus. Nexus is a government word that basically means where are your headquarters, where are your offices out of, do you have a selling office, do you have storage? If you had nexus in a state, you charge the sales tax by that state rules. That's why when you bought out of state, you did not have to pay sales tax. Notice I'm using past tense, have to. Well, there was a court case that went to the Supreme Court, and it was called Wayfair versus South Dakota. And what happened is South Dakota does not have a state tax. Their entire revenue system is on charging sales tax. Well, this worked fine for decades upon decades, because the majority of products and services, they charge on services too, was purchased within the state. Well, then come the online. Now it came about that so much of what people in South Dakota purchased was online in other states, they were not collecting the respectful amount of sales tax, right? So they went to court and said, hey, we want to have the right to say anybody selling in our state, they must follow our sales tax rules. And the Supreme Court stood by it. They said that they're not trying to get old money. They're not trying to collect old money. They're not trying to do anything to harm businesses. They're just saying, hey, if you sell in my state, we're going to, want you to charge sales tax if it's a product or service. So once that happened, a new term was born, economic nexus. Economic nexus means you have an economic advantage by that state. You're selling into that state, okay? So once that happened, state by state started coming on board and saying, hey, we're into economic nexus too. We are going to have that as our rule as well. So this requires now people who are selling into various states to understand if they are following economic nexus and what that means. Now, what it could mean is very complicated, because some states make rules such as once you sell X amount of dollars worth, you must start collecting sales tax. Other states say when you make X amount of transactions, you must start collecting sales tax. And to make it even more confusing, some states charge sales tax on products, some on services, and some use a hybrid model. Like California uses a hybrid model. Some services are taxable. So unfortunately, when you're selling outside of California, what you have to do is, and this is where this instruction sheet gives you an example so you can see what I mean, you have to go to the government's website. You have to identify if they are using economic nexus. I Googled Nevada state laws out of state sales. Another keyword is Nevada state sales remote sellers. And this will take you to their website. You don't want to follow somebody's blog. You want to make sure it's .gov, because just because today they don't, that doesn't mean tomorrow. And the information is always on the internet, so you never know if it's updated information, okay? So when you click this link, and you can do this when we're done with this and kind of get an example of what it looks like, but on the website, you'll find Nevada's new rules went into effect October 1st, 2018. Once a remote seller hits the threshold described above, greater than 100,000 in retail sales or 200 or more transactions for delivery into Nevada in the previous or current calendar year. Then they go into when you have to set up a seller's permit, and they also say, well, you can get a seller's permit and start charging from day one if, that makes you not have to be as concerned about the threshold. So in conclusion, guys, whether you have somebody else do it or not, first, you want to make sure they're doing it properly. Secondly, if you're selling out of state, you're going to have to check the state's websites. Now, there are different things that say, here's what each state requires. And in Shopify, they have a list, and I believe it's probably pretty updated, but just to double check, you might want to. There's different companies you can hire to do this. Some CPAs, some accounting firms. There's a sales jar company. Shopify has a partner. I don't have any experience with these people, so I can't say. But what I do want to say is when you hire a company for this or any type of accounting, I make the distinction that a lot of the people who offer these services aren't really accounting people. They're kind of more tech people. I see a lot of bookkeepers that do QuickBooks Online. They can't recognize when a transaction's incorrect. They're more tech people. They know how to use the app, but they're really not accounting people. So you want to make that distinction so you don't run into trouble. So that's my information on sales tax that I wanted to share with you. Now I'm going to run over here and I'm going to grab a couple questions. So Tova, I'm going to get into the basic questions in 1 second. So I'm putting yours on hold for a little bit. Let me give a second to read. So this is a common question. This person was approved for the EIDL loan above 500,000. If for some reason I default on the loan and the business assets don't cover the cost of the loan, can they take my home as collateral? Can I take a line of credit on my home if the SBA considers it collateral on the loan? Now, I can give you some guidelines on that. I can't answer on exactly what would happen, but for those over 500,000, if you did, and I'm assuming you may, if you sign a personal guarantee, what I really need to tell you about is how personal guarantees work. So I'm not going to say the SBA will do this. I'm going to tell you how personal guarantees work. So when you do a personal guarantee, which was kind of a given on any kind of loan you would have had prior to the pandemic, the amounts under 25,000 on a EIDL don't have that, but prior, even at that amount, it may have a personal guarantee. So as the word sounds, a personal guarantee is that you are personally guaranteeing that this will be paid. So what happens is kind of there's a line that it goes through. When you default on the loan, first of all, if it gets to that point, remember, these are all things that it's got to go to court, it's got to do this. So these are processes. It's not like all these come together and happen overnight. But the first thing that's going to happen, obviously, they're going to, come after you, try to get payments. Then if they have to, if it gets to that point, they're going to go through the business assets, obviously, because the loan is a business loan. Now, if the business can't cover it, then it makes you personally responsible. Now, you personally responsible, if you have no way to personally pay it, they are then going to go after the personal assets to make that payment. So that's where it can be where your home could become involved because they are going after all the personal assets in order to pay the loan. Now, this is, like I said, it's got a lot of legal stuff in between. So I don't want to make it sound like this is a direct aspect of how it all works out. It takes time and they look at all different choices, payment plans, all kinds of things. Now, when you have, that was a personal guarantee. Now, if you have a different word, I'm going to say collateral. Collateral is a different word. Collateral is where you pledge a certain asset, such as a house. It's usually a house. When you pledge a collateral such as a house, a UCC, Universal Commercial Code, goes on that asset, on that house. That gives the lender, in this case SBA, first priority on that house, and that also can affect sometimes, certain lending against the house, depending on the equity, etc. But it has to be a UCC filing. Now, I understand that, and I don't know, because these are way deep into the SBA information. It's above my pay grade. They don't let me in on this, but I understand that there is kind of a blanket UCC filing on certain assets of the business, but I don't believe there's a blanket UCC filing on your personal. Now, what I'm saying, which sounds pretty complicated, so I want to explain it this way. If I have a UCC filing by pledging an asset, the lender can get it quicker than if I just have a personal guarantee. It's got to go through a lot of processes. Can it get to your house on a personal guarantee? Yes, it can. Can it get to your house on a UCC filing faster? Yes. Is that seen when people pull up your records? Yes. Is it on a personal guarantee? No. So that's kind of how that works and the specifics. So once again, it's always a possibility, and you have to understand it is a possibility, but it is something that goes through a progression before they do that. Okay, let me get the next one to see. Oh, hold on, it just switched. Hold on, let me get that. Okay. So this person has an active business with a multifamily rental property. They've been running it as a sole prop for over 10 years. They're going to form an LLC to reduce my liability so the property can't be taken away in case of any future judgment. Once again, that can be questionable because keep in mind, even if you have LLCs, you could have, like we just talked, personal guarantees and stuff like that. But the question is, when should an LLC be formed? At the start of next year or sometime this year? The only difference between doing that is whether or not you would be subject to the 800 and it wasn't a full year. But in the state of California, which I'm going to assume this question is, there is still a moratorium that says you don't have to pay the 800 for the first year. So it kind of doesn't matter. I mean, if you are able to form it perfectly on January 1st, right? then one could say that you won't have a Schedule C for the sole prop and a Schedule C for the LLC, but it's often hard to make it work so perfect. So I think the disadvantages of forming mid-year is you'll have the records for the sole prop, the records for the LLC, but it's really not that encumbersome. And the 800 is not a factor of this year. So it doesn't say that, well, you're only, paying the 800 for a couple, 3-4 months and then having to pay again. So because of that, it's not as considered a cost, if you will. But I also want to add one more thing into this that you didn't ask. Be prepared to start a new bank account. You may know that. A lot of times people think when they go to a sole prop to an LLC, they can keep the same bank account, or if they go from an LLC back to a sole prop, that literally is the opening and closing of one company. So you're closing the sole prop, you're opening the LLC. It's kind of like a new baby born with the Social Security. The LLC has an EIN. You have to start another business account. So really, I think in this case, a lot of the more confusing aspects is getting a new bank account, closing out the old bank account. That's the one that you have to be aware of. Question regarding grants available for small businesses or employee trainings and capital expansions. There is none that I know of, Josephine. That doesn't mean they don't exist, but during the pandemic, we had a lot of ones that were being offered. There is still the California Relief Grant, but they're going on applications that have already been submitted. I do not personally know of any new grants that are coming up. There are certain things involved for employee training that come up per situation and geography. What I would do is I would check with your local chamber to see if they're aware of anything. There's also government websites you can see about grants. There's certain requirements that you have to do. So in other words, we're back to the pre-pandemic days when grants were not as easy to come by. There are a few you can check into. You got to kind of look up and see. And that's where we're at. I don't know of any new grants that are coming up. Let's see, pros and cons if a company goes into bankruptcy. Well, it's really, that's a hard one. There's just so much in it because it's a personal situation. If the company is a sole prop, it's one thing. If it's incorporated, it's another as far as responsibilities, right? So it all depends on if, I think it comes to this. As I'm thinking through and trying to answer this question, I've had to literally drag a couple clients to bankruptcy because I said, hey, the writing's on the wall. You've got to close. You're losing money. It's not going to work. And as I was starting to answer this, Ruth, and I was trying to go through all the different mechanics of bankruptcy and the financial aspects, when it comes time for bankruptcy, from my experience, is when the money's gone and it's not going to come in. Guys, I'm always talking about you got to know your numbers. You got to know your numbers. You got to do forecasts. You got to do forecasts. I scream about it all the time, right? So if you are doing your numbers internally properly, you're doing forecasts, you're getting a feel for where you're going to be, the decision to file bankruptcy becomes apparent in the numbers. You all know with Michelle last week, we talked about it. What I did is I ran some forecasts, I did some numbers, I did some financial modeling, I did some what if scenarios. What if we reduce this? What if we reduce this? What if the sales would do this? When I got the numbers, and I play with it like in a Rubik's Cube, right? And then what I do is I make the model be cash positive, right? I make the model have enough net income to live on. And then I look at the answer. So I don't always I forecast and look at the answer, but then I say, what would it have to be? What would it ultimately have to be to make this make sense to go forward? Once I do that, I can look at what numbers it would have to be. And if it's like a 200% or 100% increase in sales and that ain't going to happen, if it's a huge decrease in expenses and that ain't going to happen, I know bankruptcy is inevitable. So you might as well get around it, handle it, and take care of it before you drained every penny onto the company. So I would say it's not about pros and cons. It's where you are financially, where you're going to be, and getting an understanding of it's financially feasible. That's my bottom line on that one, guys. Financially feasible. If it's not financially feasible, there's only one choice, and that is to file bankruptcy or do something to get out from underneath it. But that's how you begin to answer that question, not with a check, 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 check. You do it with a financial model. Does this apply to internet sales as well as sales at someone who comes to your store and requests shipping? I'm not sure exactly what you mean by this, Donna, so I'm going to answer sales in general, sales tax. So sometimes internet sales are taxable, if it's a product and it's sold off the internet. Yes, this is internet sales, right? That's absolutely correct. If it's a ebook, you will not necessarily pay tax on ebooks and some digital books. So some things in California have really specific rules, right? But if it's like a product and you're selling it off the internet, yes, it doesn't matter how you are selling. It's not just about coming into your store. So I'm going to assume that you're saying, hey, when I say you're selling into another place, yes, if you're selling through the internet and you're dropping this product's being shipped through the internet, yes. If it's a digital product, some digital products are not subject to sales. So that's what I wanted to answer on that. Let's see. How much? So the enforcement agency, so Don is asking me, who's the enforcement agency if you screw up? In the state of California, let's see if I can get this right because they changed their name. Department of Tax and Fee Administration. That is the people who will come after you. That's who deals with it. Is it possible to open a business in another state but sell in California? Absolutely. People do it all the time. But I want to be really clear and add to this question. If you are engaged in California, like you're a resident of California or your office is in California, remember I said a little bit ago about Nexus being physical, presence. If you have a physical presence in California and you open a business in another state, like you try to just incorporate another state, you still got to get documents to be a foreign entity in California. So don't feel, I get this all the time, people think they can incorporate in another state to avoid any type of California tax. No, I always kid around and say, but it's true. If you want to avoid California tax, you got to get out of California. So as long as the business is located in California, you are going to have to pay the corporation tax and you're going to have to file a document that's called a foreign entity doing business in California. Now, if you are not in California, like I am not a resident of California, my company is not in California. And so when I sell into California, I sell services, right? So I absolutely can. If I sold products, I would have to follow California's product laws or sales tax laws, which has, I believe, I haven't looked it up in a while, but you can look on their website. It has a certain number of units sold. California requires sales tax to be charged on products pretty quick when you sell into California. So you would literally, if you're outside and you're selling into California and you're not a resident or anything of California, you would then set up a seller's permit in California and remit your taxes accordingly. But if you're in California, don't think you can open a business by incorporating in another state just to avoid paying the $800 and all of those other fees that are required for doing business in California. It doesn't work that way. So many people do that, and then they end up having to do a tax return in the state they filed in and a tax return in California. It's this really ridiculous thing that people get caught up on and believe they can, and they can't. I see it all the time, and I'm having to fix that for a lot of people because they don't understand that. Okay, so this is a question. I'm an absolute beginner and frankly don't know where to start at all. I'm looking, hold on, it's just every time I do that, it goes. So Lauren, just wait till I read the question to click it as answered because it jumps up on me. So just wait till I finish it and then do it. I didn't know it until this time. I'm realizing that's why it's doing it. Okay, back again. I am an absolute beginner and frankly don't know where to start at all. I'm looking to start a food truck business with an LLC, but the first step into the right direction. Or you could start as a sole prop. Now, a lot of the food trucks are not LLCs. That's another thing I try to tell people is it doesn't necessarily mean that you should automatically file as a LLC. An LLC is often more complicated than people even need to be. You can easily start as a sole prop. In fact, don't quote me on this number, guys, but it's like 82%. I read this in my IRS book when I was studying for my enrolled agent, of companies in the United States as a sole prop. You know, people just get sold on, oh, I got a business idea. Let me open an LLC. I mean, it just drives me up a wall because people get them down a road they don't need to be. So you can absolutely function as a sole prop. You can function as an LLC, but there's the one thing I want to tell you. I don't have the exact date yet, but I think it's going to be sometime near the beginning of April. I am going to have an expert on as a guest interview about the trials and tribulations of his owning a food truck. He has done very well with a food truck, and he's going to talk all about that. So be sure to tune into that one. It's going to give you a lot of the information you need for a food truck. Okay, this one's, I heard you can ask for an EIDL loan increase for up to 2 years from when it's first given. Does that mean we can ask for more money? I also read that no personal guarantee was needed for amounts under 200,000. I currently have 120,000. Can I act for 80,000 more? What do they base the decision on? Yes, you can. It's till 2 years, or guys, or they run out of money. So you definitely can still ask for more money, but if the grant runs out of money, then you won't be able to get it. I'm not sure on what amounts they ask for personal guarantee. I've seen it different places, so I don't want to say that it's this number versus that number. But what does happen when you ask for additional money, they get a 4-506T again, which allows them to look at your tax returns. They're much more thorough in the underwriting. They have you do a schedule of liabilities to find out what your debts are. They really dig deep, and they look at how much they perceive during the underwriting that you can borrow up to, and they identify that number. If it is requiring a personal guarantee, you would know, before you do so, and you can take a look at it. It's just that they change it all the time on that, and I'm not sure where they are on the personal guarantees, and I'm not sure if they'll change that. So I want to say I don't want to commit to anything on that. But what you'll do is ask for the increase. You can do it through the portal. You're going to have to give them your tax returns and everything, and they are much more thorough in underwriting for the increases than they were for the original loan. Okay, this person's filing 2 rental home properties in California and 1 in Oregon, currently filing a Schedule E on my tax return. The Schedule E is when you have rental property. It's not seen as a business per se, but it's how you file for your taxes when you own these property. So that makes sense what you're saying. Oh, if you put the properties in an LLC, you still could possibly be doing it on the Schedule E. The only way you can get to a Schedule C would be if you have a certain amount of expenses, et cetera. And there's a lot of guidelines on that. So I'm just going to answer that partially because I'd be going on and on into the tax laws on that. But it's something that you still could do as a Schedule E because it's really just property from rental. The LLC is more about the structure of the company. But I would say, Barbara, please, if you want to reach out to me with that question, give it to Lauren, give her your email or email Lauren. She'll put it in the chat because I would like to get a little bit more on this because I know enough about it, but I got to go back and read the IRS stuff on it to make sure I'm answering your question correctly. I have quite a lot in my little brain, but sometimes between tax, finance, and legal structures, I have to go back and review some information. So I'll have to go back and review that. Delivery service taxable in California. Chris, this is an interesting one. You would think not, right? I ran into a situation as a CFO many years ago where a company was delivering and installing furniture, but they were putting it together on site. And, everybody always says delivery, installation, not taxable. And I found out because they got an audit before I came on is that California had a very interesting law that certain installation and delivery can be taxable. So I'm going to ask you as well, please get Lauren's email, send me an email so I can send you back a link. It has a link to the California tax and fee. I think that's where I got it, but it tells you what kind of labor is taxable, what kind of delivery is taxable, et cetera. So that is a really good link because you can look up your specifics. I used to always be able to say yes, no, until I had some of these experiences. And I realized it's yes, no, maybe. And so it's really important to kind of know the specifics. But if I send you the link, you'll have an idea of what is and what is not. And sometimes you just have to call them. This was some time ago, I was doing a lot of on-site seminars, and I also have ebooks that I've written. right? And I sell my ebooks on Amazon and stuff, and I sold them on my website. And I was not charging any sales tax on my books because, you know, digital products were not taxable. And then I worked for this company I told you about that I realized that there's yes, no, maybe. And I just got a little nervous because they got involved in this big audit that I would have never guessed. So I actually called them and said, okay, I'm selling ebooks. These are not taxable, right? And they go, yes. And they go, but what else are you doing with them? I go, well, sometimes people buy the ebook and then they take it to my seminars. And they told me, well, when they actually take them into your seminars, they are sales taxable. See, how would I have ever guessed that? You know, okay, if I sell the book online, it's not taxable. If then they buy it and come to my seminar, like my handbooks, it is taxable. So sometimes when in doubt, you just got to call them because their rule book's pretty interesting when it comes to certain things that you wouldn't have guessed. I never would have answered the question like I had I not had that experience with that one company. I think that's kind of the advantages. I've had so much experience working with so many different companies that it's kind of a collection of understanding over the time period. So let's see, I've got one more. So go into detail on a sole prop. And what a sole prop basically is, it's called the default status, and default meaning that I didn't incorporate. So a sole prop is just the matter that you start doing business, right? And you show how much money you're bringing in, you show how much expenses. I suggest that you have a separate bank account, but it's not required that you do. You can either do the business under your own name, and then you can use it in just a regular checking account. If you want to have it under a name other than your surname, you file a DBA. And so a sole prop is the easiest type of company structure to operate. The disadvantages of a sole prop is you don't have a risk protection. So if somebody sues the company, they sue you, not the company. But a lot of times, you know, the chance of getting sued is pretty small. It's not an industry that you normally would get sued. And a lot of times people think, well, if I get a company, then I'm not going to be responsible for the debts if it goes bankrupt. And that could be true, but leases and bank loans, which are the two biggest debts for most companies, those are actually personal guaranteed, like I talked about a little bit ago. So in some cases, people probably would never get sued. They don't even own that much assets. If they do, I've had people that are a leased car, living in an apartment in, you know, some kind of industry that they never hardly would get sued, running an LLC with all the expenses. It doesn't make sense. And the only other advantage of being incorporated would be taxed as an S Corp. You can be an LLC taxed as an S Corp or an S Corp. But in a general rule, you need to be about, I'm just generally speaking, this isn't a hard number, but at least 30, 40,000 in net income before you can have any tax advantages. And you have a lot of cost with that type of structure. So I always say, you know, start as sole prop. It could be the easiest. You could see where it's going. And it's kind of like, I don't know if this is incorrect to say, but it's kind of living with somebody before you get married. You know, you can unwind living with somebody better than you can unwind a marriage license. So you see if it works first, and you decide to go from there. Okay. So now what I'm going to do, with a couple minutes left, I'm going to share something real quick. Let me stop this and get to something else. So give me 1 second, guys. And I know that I wanted to make sure I kept enough time for a good amount of question and answers, but so I may want to go over this with you guys again at some point, but at least I want to throw it out there to follow what I spoke of before. So one of the things that I want to explain to people is there's two types of accounting. Now, what I'm about to say, don't try to memorize this. There's no test on this later, guys. It's just to give you a concept of understanding. So that's all I'm trying to do right now, is give you a concept. So there's two types of accounting. There's financial accounting and managerial accounting. Now, financial accounting, its main focus is the preparation of financial reports, like we've been talking about. Your tax returns. What do you need to know to file your tax returns? What does an investor need to look at? What would a government authority need to look at? And financial accounting is like the income statement and the balance sheet. It follows a very specific layout, a very specific format, and it does so there's a transparency. When I look at a income statement or a balance sheet or a cash flow, I know exactly what the categories are. I can have a little transparency into the company. And this is what makes our system able to invest in companies, et cetera, because it follows a very specific format. And those are, like I said, income statement, balance sheet, cash flows that you're familiar with. But this is the part that 99% of the small business owners don't recognize. There's another type of accounting, and it's managerial accounting. And the main purpose for this is internal decision-making and financial control. And this is where the small companies lack. This is my kind of soapbox thing that I'm always trying to really push you into at least having some kind of understanding of what's going on within your company. Now, Lauren, I'm going to say, I want to make sure people can see this managerial accounting. If they can't scream out to me, I think they are. I got so many screens open. I just want to make sure. I'm going to keep going, believing you guys can see it. Now, with managerial accounting, what you're doing is it doesn't follow a format. It's your choice. You can mix and mash information. You can do it any way you want. You're not giving it to an outside person to see. It's something you do internally. And some of you may have some of these. You might have a sales report, but you're lacking financial performance and profitability reports. And managerial accounting is what CFOs and what I would do in big companies. I have all these separate Excel documents. And it doesn't matter whether I have a really elaborate accounting system or not, I am still going to have a ton of Excel documents. In fact, the bigger the company, the more Excel documents that you have, right? So when you look at your data on a financial accounting, it is cash versus accrual accounting. And what that means is cash in, cash out. So if I ended up getting a certain amount of sales come in, revenue in my bank account, and then maybe December, I bought a bunch of inventory for next year, that cash out will be the inventory for the following year. So if I look at a P&L, it's not going to line up my total revenue to my total cost of goods. That doesn't let me know if it's gross profit. It doesn't have any idea. It's not doing what they call the matching principle. I'm not saying this is how much for a unit sold. This is how much it costs. This is how much it is to produce. This is my gross margins. It's not calculating any of this stuff, right? And this is what you need to manage the company with. And this is what I see as the primary reason why a lot of people will look at their P&L, they'll think that's, okay, I made this amount of money. No, that means in the way the cash kind of fell in, that's where it lined up. But it doesn't mean the company actually made that amount of money, because it's more of a log of all the transactions that occurred. Now, all companies under 26 million use cash-based accounting, and they should, because accrual accounting is very, very complicated. But at least having an understanding of how much you're making on each of your products, how much you're making on your services, that's crucial. So that's why I am saying, well, you can create that. You can create that information and do it in a managerial accounting way. And so with that, what you have to do is you got to extract any data from your financial reports and then add additional data. So in that, with the cost to produce, I went through this before, so I'm going to go through these first pretty quickly. How much does it cost to produce my product or service? So you can see I took product A, product B, I made up some things. These are all made up numbers, right? I can use estimates. I can, say, hey, this is about what it would cost to produce, but I'm saying, how much does it cost to produce? Now, if I'm in a service business, I'm going to say, well, how much am I, if I was to go work someplace else, how much would I bill for? Because you don't want to be making less money at your own company than you would someplace else, and with a large amount of difference, right? Obviously, there may be some because you got some benefits, but use the cost to produce as in what you would pay somebody else to do that service. Because if you don't analyze how much you should be paid to do the service, if you grow, there's no way to have money to pay somebody else to come and help you. So that's why it's really important. So if you were a service-based company, you would just have contract labor and the price to produce, and you would figure the amount of hours based on that, and that's another income going to you. Then you would create something that has the overhead, rent, marketing, per month, per year. Very simple, nothing complicated here. You can use a percentage. You can consider the cost you're paying for personally, rent, computers, Once again, I really stress including these numbers, because if you do forecasting on, I'm going to use my own stuff, I'm not going to pay myself, I'm not going to pay myself reimbursed for any rent, you're going to create forecast and a company that does that. So you really want to include all the cost, okay? Then you just go to where you say, what is the selling price? I'm going to sell it for 18. I already know my cost of goods. I know that that's 8 gross margin, 18 minus 10, and I know that's a 44% gross margin. I know on my product B, I all made up, guys. Once again, may not make sense. I just made these up. I sell for 20, cost 6, gross margin 14, 70% gross margin. Then I do a sales forecast. Well, how many units am I going to sell per month? 1, 2, 3, 4, keep going. How many will it be per year, right? What will the revenue be? What would the cost of goods? I'm just taking all these numbers and bringing them together. Then I can create them in an income statement. Okay, so all I did here is what's the selling price for 1 unit? What's the cost for 1 unit? How many units do I plan on selling? What would be the revenue? What is the yearly overhead? And then I can turn around and just say, well, the cost of the unit per the number of units I'm selling, or I'm sorry, the selling price for the unit versus the number of units, the selling price of the unit versus the number of units. That's my total revenue. Very simple. Back to the same thing. Cost of the unit times the number of units, cost of the unit times the number of the units, total cost of goods, okay? Then I can subtract these two numbers and I can see my gross profit. My gross profit from product A is 4,000. My gross profit from product B is 3,500. Just subtract 9,000 from 5,000, 5,000 from 1,500. That's where these come from, very simple. Then I can add up both to say collectively, what's my gross profit? I knew my overhead, I calculated that, and then all I got to do is subtract my total revenue from my total cost of goods, or I could do my total gross profit, and I get my net income. Now I got a perfectly matched income statement. It examines how many units in selling price. It's not based on when cash came in, cash came out. It's totally matched. I have done accrual accounting to be able to do an analysis, okay? Then what you can do is some real fancy stuff. I'll get into this more again, and if anybody wants to set up a one-on-one with me, we can look at your numbers on this. This one takes a little bit more to describe, but I'll go over it. So this is just what you saw before. Nothing different. I didn't change, no hocus pocus. These are the same numbers. Then what I did is I took revenue and divided it into revenue, 100%. And you can see the formulas. I took cost of goods divided into revenue. I took gross profit divided into revenue. I took overhead divided into revenue. I took net income divided into revenue. All I did is use revenue as a base. I divided these and I got percentages, okay? Then what I'm doing is I'm saying, what is the percentage of cost to revenue? Well, it's 46% cost to revenue, money to produce my goods and services, okay? I'm going to be sending out a PDF with you with this, guys, so let that be known. 21% overhead. This is the money that is left over for overhead. 32% net income to revenue. So all I did was picked up these same numbers here. Up here, I told you the formulas. Up here, I told you the meaning. Now, everybody focus on this circle. In my company, it cost, out of 100% of revenue, 53% cost of goods to produce the product or service, 12% to run the company, 35% is left over for net income. Once you know this, you can plug in new numbers and you can do a bunch of what if scenarios. And over here, I'm just focusing on the cost of goods and the gross profit, because the gross profit represents what's left over to pay for expenses. It will help me to better manage my expenses. And then, like I said, you can do what if scenarios. This is the percentage and this is the analysis. I could come back here and I could say, okay, what if it's now costing me a little bit more to produce? What if my cost inflation, we're all talking about inflation. What if it went up by that amount? I can come back here with the new numbers in and I can see what's changed, you know, where these numbers could change. I can plug in new numbers. So you just start plugging and playing in new numbers and you analyze each of these sheets. I normally would have it on one sheet, but I was trying to break it out. So in summary, if you must do managerial accounting, you must have some kind of internal understanding. You must know how much it costs to produce. You must know what your overhead is. You must know what your selling price is and how many units you plan on selling. Then from there, you can figure out the units you plan on selling for a year. You can create an income statement and you can divide everything by revenue to figure out the percentages. You can insert new numbers to see how that changes. Although my forms as a CFO were much more elaborate, this is a very simplified method that I use with companies constantly. And you can answer questions like, well, what if this went up? What if I change my product price? What if I sold it for more? What if I sold it for less? Can I afford to hire somebody? Should I go bankrupt? These little tools are just fascinating. I like Excel because you can plug them in and see the answers to be changed, but each one is customized to the company's situation. But it's like anything, no matter how complicated like the algebra formula would be, it comes back to A plus B equals B plus C. This is the fundamental underlining concepts that I use to financially make decisions within companies. So I broke it down to its basic element. So with that, Lauren, I'm going to go a few more minutes just to kind of get through some of these questions that came in. If there's any I can pick at real quick while I was talking. So the one about Lori's basic 4 questions, I answered that. What you want to do is you want to figure out what is the amount that you would be charging if you hired somebody or you would expect to make someplace else. So you at least have that, as you could say, like baked into the cake. If you want to make sure that that's at least included. Okay, I think I actually got all the questions that were asked. If I missed you, please send it an email, give it to Lauren, tell her to get in touch with me, send an email and ask to meet with me if you want to go over some of these specific situations. But with that, Lauren, I'm going to hand it back to you. And I want to say thank you, everybody. And once again, if you want me to go over the last part again, I can create a whole show just on that. I just don't like to get bogged down on a lot of details on this show. I do teach this in specific webinars where I go really in deep, but this show, I try to give you a little bit of everything to satisfy everybody that is joining us. And I want to thank everybody again from the bottom of my heart for always being here. I look forward to Wednesdays. I know Lauren looks forward to Wednesday. We're having a lot of fun, and I really hope it's helping you guys out. Lauren, back to you.
Thank you, Lori. Oh, I just turned my screen back on. Thank you, Lori. Here I am. Jennifer, I see your question there, and Anonymous, I see that you've sent a question. Please send me an email at lsimpson@lbcc.edu. If you hang on a second, as soon as I finish talking, I'll be sure to type in my email address so you guys have it there. If not, go ahead and scroll the chat area and you'll find my email there. Thank you again, Lori, for an amazing show. Super informative. For those of you who continue to have questions, please.
There, I get a little baby in the background.
Sorry about that. For those of you who still have questions, please please be sure to send us an email. I'll be including a link as well as my email address. That link is going to be to our submission form. That form is going to allow you to submit questions as well as show topics. Excuse me. And then I will also be sending out a recap email. And Lori, that recap email is going to have a link to our YouTube channel, which will have all of our recordings, especially today's recording. And with that, a huge thank you to you again and to everyone who joined us today.
Thank you. Bye-bye, everybody.
Have a great day, everyone. And we'll see you next week, Wednesday at 10 a.m. for another amazing show. Thank you. Hi, Jennifer, I see your question. Sure, let's let everyone drop off and then I'll hang on for you. I'll also include my email address so that you can shoot me an email in case you drop off. Mary, shoot me an email and I will see if I can't send you a list of Lori's webinars or upcoming webinars. The one that I'm familiar with is going to be this one, which is every Wednesday at 10 a.m. Thurman, I see your question in the chat. Please send me an email. Let me actually add my email to the chat one more time so you guys can shoot me a note. There you go. Janelle, I just posted my email address so you can see that. Mary, thank you. Thank you, Jennifer. Okay, Donald, I see you. Thank you. Ruth, glad you enjoyed the presentation. I think that's everyone. Jennifer, it might be easier if you go ahead and send me an email and then I'll send you a link to a meeting and then we can talk.